Okay, so welcome again. It's a special, training session, this evening. We're going to be looking at basically what I think every trader should know. What I think every trader should know, not just, newbie traders, but even those who are at intermediate stages or even advanced stages. For example, it was the case like I posted in the Telegram group, last week, that even though the week was okay, it was a decent week, it could have been better. And after I did some sort of review, I realized that there were things there were some reasons that were responsible for, the week not being better than it was. Even though, yes, I am, an experienced trader, but there were some things that I ought to have done that I did not do. There were trades that I ought to have entered, but did not enter. There were trades that perhaps were at key levels or near enough key levels, like we have on there, but I did not enter the trades because the price had left those key levels only slightly. What I should have done was to place, limit orders, there, so that, if it was a bullish move, all I needed was for the price to pull back a bit and trigger me in to continue. If it was a bearish move, for it to pull back up, take me into the trade and continue. But I missed those trades, and it's almost as though I forgot that limit orders are there for a reason. I suppose I suppose I could make an excuse for myself, saying I have been used to taking market entries for a long time now. For quite a while, I've not been using limit orders, and I've gotten so used to entering the market at market execution that, I basically almost forgot that the alternative would have been to place limit orders, because most of the time, like we know as traders, we will see that today, most of the time what tends to happen is that the market will come back to where you would have entered initially. The market will tend to come back to that area, because after all, now listen to this is important. After all, if you are getting in at a key level, if you are getting into the market at a price point where something is going to happen, the market will usually give you a second opportunity. Hopefully, we'll see that even today. So let's just quickly have a look at this. So we're going to be looking at key levels today, market structure, support and resistance. We're going to be looking at head and shoulders pattern. Maybe not in depth as it is, because obviously the past members did follow us when we taught it, and the current members also definitely, well, they still have the opportunity to keep on trading it and watching the video. So we won't be going too deep. The questions that were sent to me, some of the questions that were sent to me were largely on head and shoulder. So I thought, okay, fine, I would answer some of those questions. We're going to be looking at entries and exits, how to enter trades, or some of the ways to enter trades and exit it as well. There are lots of ways, but we'll be looking at a few. Then obviously we would have Q&A session, and there'll be a little something for for you. There'll be a little something for you at the end. So stay till the very end. So what I'm going to do now is to basically go back to my chart. Let's go back there. Okay, so this is This is, USD CHF. This is, the USD CHF. I mean, it could have been any pair whatsoever, but I'm sure, like most of you know, especially those who have been with me for who have known me for some time, I usually don't cherry pick what pair to look at. I basically just ask you to choose one pair and we will work with that. So it wouldn't be the case that, I had some thorough analysis of that, before. Guess what, guys? Guess what? Let's do that. Let's do that. No cherry picking. I mean, if you don't choose it, if we can't find a good pair, then I'll come back to this. Give me a pair. Let's look at support and resist. Let's look at market structure. Just type in the box there. Just type in any pair. No cherry picking. Sometimes when we are okay, US, Euro, New Zealand dollar. Okay, because sometimes it might be as though you're just cherry picking. It doesn't, what you are talking about doesn't work for all pairs. It doesn't work all the time. You've just cleverly chosen the pair. Let's go with what Yemisi has sent. Euro, New Zealand dollar. Let's do this. Euro, New Zealand dollar, where are you? There we go. Okay, so this is Euro, New Zealand dollar. Okay, I'll tell you, let me move this. I'm having to, let's do that. Okay, so, well, fine. I mean, the pair I had on earlier on was USD CHF, which was bullish, which was in an uptrend, but this one seemed to have been in some kind of downtrend. So that's fine, it's the opposite. So what we're going to do to start off with is to identify market structure. Now, I know that is basic, but bear with me. Sometimes I do go very basic, just to make sure everybody gets what it is. I mean, there are times when you're teaching and you think everybody knows what you're talking about, but not everybody does. So this is Euro, New Zealand dollar. We're going to look for market structure, and some of you might not have heard me say this before, others might have, when you're trading, even as we are here now, this is the daily time frame. We can all tell that this is the low on the daily time frame. Now, this is basically the overall low. This is the overall low. So, yep, if you could post your questions, that's fine. But I will answer the questions, later, or I'll have a glance at the chat box, intermittently. So on the daily time frame here, we see that this is the low, the real bottom, if you like. This is the bottom. We could also call it structure, but this is not the only lows here. It's not the only structure low or market low. There are other lows going up. There is that one. There is this one, and this one. These are all swing lows. These are all structure lows. But this is the overall low, if you want to call it that. So let's do this. Now, when you're trading, I mean, as a trader, especially as retail traders, you're going to be either a swing trader, a day trader, or a short-term trader. Now, when we say day trader, obviously we know what that means. You open the trade one day and you intend to close it the same day. Short-term trader, what I would sometimes call a medium, I'm sure you've heard me say medium to long term. A short-term trader and a medium-term trader, in my opinion, are the same thing really. You are leaving the trade open for some days. Then of course, if you are a swing trader, even though sometimes you want to swing trade, you are able to capture one swing in the market in one day or in 2 days. So a swing trader is not necessarily one who keeps the trade open for weeks. A swing trader really is one who seeks to capture one swing in the market, whereby, like we know, I say this all the time, the market always does a zigzag. It does not go down in one straight line, neither does it go up in one straight line. If it's going down, it's going to be having the impulse move, the correction, impulse, okay, fine. Impulse, correction, continuation, which you could call impulse as well. Let's stick to impulse. So impulse, correction, continuation, impulse, correction, then, continuation, correction, continuation, so on and so forth. So that's the way you will have it. If it was in an uptrend, it will be impulse, correction, continuation, correction, continuation, and so on and so forth. It would not just go in a straight line. We all know that. We all know that. So having said that now, it is the case that when the market goes like this, let's go back there. Where is it? Where is it? So when the market goes like so and it corrects, you might be looking to capture the next swing up. So this swing down, which is a correction, it's nevertheless a swing. It's a swing. Swing low, you might want to call it that, but it is a swing. If it moves, if it continues, it is another swing, so on and so forth. Now, as a trader, especially if you want to play it safe, the best swing to capture is the impulse move or the continuation. Not so much the correction, because the correction is more or less short-lived. So with this one here now, this is the one you want to capture. So the ones pointing up are the ones you really want to capture, because they're going to give you more pips and profit. Not so much the correction. I mean, obviously, if you're more experienced, you can do that. I mean, those of you who trade live with me, I trade both ways. I mean, but the best moves to capture are the impulse moves or the continuation moves. The impulse, when it begins, it's an impulse. Like here, for instance, when this one went up, it was an impulse move. Correction, continuation, correction, so on and so forth. Something you might want to know, guys, something you might want to know is that the very first impulse move is difficult to catch. It's not everybody that can catch it, So by that, I mean this one, because you can't be sure what the price is really going to do yet. Now think of this one. When the price first swung up like this, I mean, this is daily time frame. When you see this first candle, after this bearish candle, when you see this first one, you are going to say, okay, fine. It seems like it's going to reverse, but guess what? You are not sure yet. If you are a savvy trader, you really don't want to be jumping in this trade unless you have other reasons or confluence, reasons to get in. The very first, bullish candle, it's not necessarily, when to jump in. You might want to wait for confirmation. Okay, fine. You got the second candle and you are there thinking, oh yeah, I think it's going to go higher now. Why? because price, as you can see here, has closed above a recent low. My goodness, you are getting some nuggets here today. Price has closed above a recent low. That gives you an idea that it seems like something is going to happen. It seems like something is the price is going to push up. Why? Because we see here price has closed above this recent swing low. That was this candle closing above it. But is that necessarily enough? Maybe not. Maybe not. So if you entered here, or if you entered here, by the time the price got here, it now began to consolidate. And you are there thinking, oh no, oh no, oh no, 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 no. Oh, I know you guys follow YouTube, but you follow Instagram as well, so don't pretend. You know that song. Listen to this, listen. You might not want to get in here just yet. We've drawn the line there, marking the previous low. Price closing above it is not necessarily enough. You want to now see price begin to push above that line, that support, because that is what it is. When the price was here, this was resistance. But when price closed above, it now becomes support. Well, you know what I teach. Support and resistance are the same. It just depends on what side you are on. Now, with that one, with this push up, you can now begin to think of, oh yeah, I think I can get in here now. I wish we had all the time to teach every single thing that I'm seeing here, but we'll just touch on some things. A big candle, you know what I teach. Don't necessarily get in at the very close of it, because if it's a large candle, price would most likely pull back. So even if you decide to get it, you place your limit order, which is one thing I didn't do last week, which I should have done, and hence would have gotten a lot more profit than I got. I did not use stop. Well, in this case, the buy limit. You would have been good to use a buy limit order here. Let's make these dotted lines. You know I love to use dotted lines as my entry. After the big candle, you'd have waited for it to pull back. Even if you got in here, guess what? Even if you got in here, that would have still been good, because you are going to have enough stop loss. Well, the stop loss is going to be large, because if it's a large candle, it means large stop loss. So whether you got in here and decided, oh, well, okay, that's 260 pips. Now, we are retail traders. Not everybody has a large account as a retail trader. So it would not have been wise to get in there. The best entry would have been this one. So let's move this up. Let's say we are savvy traders. We don't chase trades. So you would have waited for a pullback here. From here to here, that's about 195 pips. Well, it's still much, but let's go with that. So you make sure the price closed above this recent swing low before you decide to jump in. You might even decide you're going to wait for the price to come as close to the key level. That is what it is. Even in my introduction at the beginning, when you saw the topics to be covered today, you saw key level. Even if you decide to wait for the price to come back to the key level, that would have been good as well. Or, you wait for price. You could place this here as another key level. Am I just choosing areas and calling them key levels? Am I just being arbitrary here? No, 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 no. Let's do this. Initially, we marked this up. We saw it was a key level because there was a swing low here. Now, even if we decide to go in the past, we might not have time to do that, but let's just try. You will see this is probably a key level somewhere. It usually will line up with some other structure low or high. Let's go. Let's try. Oh, my goodness. I am not making this up. I am not making it up, am I? You know what? Let's change the color so we can differentiate between these two lines. Let's make this one a solid blue line. So there are two lines here now. There's the lowest of the low, and there is that one. So this is a key level. Why? A key level usually, would usually, even if you go in time, go back in time, you will see that a key level holds. Key level is a key level. Let's check this out. Let's go back in time. Of course not. I'm not making it up. Look at that. Maybe if we go even, well, there was a fake out here, but it's key level. You see, whenever price got here, there was a reaction. Anyway, I suppose we've proven that. Let's carry on quickly because we've got we've got less than 1 hour. So we see here that this is a key level. You would have to wait for price to break above. Now, I said all this. I said all this to say this. It is difficult. Well, I suppose you could say I said all that to repeat this. It is difficult to catch the very first move. It's difficult to catch the bottom. It's difficult to catch the highs. Some people are waiting to only get into the market when it has gotten to the very bottom, so they will have some huge pips, or perhaps they want to catch the trade at the very top so they can trade it all the way down. Don't necessarily bother with that. Just collect whatever pips you can get from the market and be done. You could find, that's for another day. That's for another teaching, maybe how to catch the lows, because yes, you can catch the lows, but it's not easy to do. Now, if you look at the Elliott wave theory, for instance, the Elliott wave principle, I know I have not taught that yet. Obviously, that is somewhat advanced. The Elliott wave principle basically, you have it's a 5-wave pattern. It's a 5-wave pattern. I don't want us to be distracted today by other things, but let me just quickly show you something. Now, just in case you thought this was going to be basic, I always throw in some intermediate stuff and some advanced stuff, because I know it's going to inspire some of you. Sometimes you find out what is intermediate is not so intermediate. Somebody who is a beginner can actually, get it. So let me throw this in. So when you talk of Elliott waves, for instance, it's usually a 5-wave pattern and then a correction. So we're just going to quickly touch on that. So the wave one could be, oh, this is big. That is too big, too big, too big. The first wave could be like so, and it's difficult to catch the very beginning of the move. If it's trending up, it's difficult to catch. So that is wave 1, wave 2, wave 3, wave 4, wave 5. So we are having 1, 2, 3, 4, 5. That's a horrible looking 5. Anyway, it is a 5, I can assure you. So when it's done, when it's made this 5-wave move, it then begins to correct going down. We're not going to bother with that. It's always difficult to catch wave 1. Guess what? That is why, it is the case that wave 3 That is from here, wave 3 and wave 5 tend to be the bigger moves. Woo! Now, you're going to watch this over and over again, guys. You will need to watch this over and over again. And of course, you need to practice by looking at your charts, different pairs, and see when it works. You know, I hate to leave you with just this much on Elliott wave. I would have wanted to teach some more, but you know, we don't have the time. Now, because it's difficult to catch the first wave, that is why it's not as big a move as wave 3 and wave 5. It's almost as though the first wave catches everybody or most traders unawares. Then there's a correction, and all of a sudden they realize, okay, this is the beginning of the move. Once the correction is over, the very, what do I say now? The smart ones, the smart traders would then jump in after the correction. That is why you will see the wave 3 tends to be bigger. The wave 2 will be small. After all, it's just a correction, it's just a pullback. It could usually pull back to the 50% or the 61.8. But when it begins to move, a lot more traders jump in. All those traders that missed the initial move, they jump in at wave 3. They wait for the correction and jump in again wave 5. Anyway, let's leave that there. Let's leave that there. So that's basically why it's difficult to catch the very first move. And apart from it being that it tends to catch us unawares, it's also not the safest thing to do, to try and catch the bottom or the highs, you know, the ceiling, or it's not the best, it's not the safest way to trade. So that is basically structure. We're basically looking at structure here. We see that there is the low here, structure low, it swung up, came down, up, and consolidation here. You can see between here and here, it's basically consolidating or ranging. And I am going to be what? Thanks a lot, MEC, for this pair, because I am now going to keep my eye on this and watch. Well, apart from the fact that it is a pair that we love to trade. I can see MEC still loves this. Okay, so we are going to keep. I am going to keep my eye on this pair now. Having seen this, I mean, I think it's going to be reversing. If we pull out the moving average, I'm sure it's just above the 50 now, or maybe it's coming close to it. You know, which will give us more, which will add to the confluence. Oh well, oh well, oh well, oh well. It's above the 50, so we have more confidence that this baby is going to begin to move up. Anyway, let's leave that one. Let's leave that one. So that is basically what we're looking at. I want us to take note of structure. You know, every trader should know that as a beginner. You know, so let's move on to some other areas and see where we can find structure. When we talk of market structure, you know, it's important we know where the structure is, because we know that is where the price is most likely going to take off or bounce off. The price is either going to bounce off structure or continue at structure. You know, when we look at head and shoulder, we will see a bit more of that, you know, shortly. Okay, so with this one now, you know, let's look at where we have structure. Let me turn off the video for now. Okay, so here, looking at this, just in case you still have not got it, guys, you know, just in case you still have not got it, let's basically show, or let's identify structure. let's identify structure. So we're looking at when the price basically swings in one direction or the other, what does it do? It forms structure. My. So we look at this. When the price moves like this is an impulse move, and then it corrects, it forms structure. Basically, when it moves in the opposite direction, it forms market structure. So there was this impulse move, the correction, forming structure. When it continues, it forms structure again because the price is moving in opposite directions. When it comes back this way, it forms structure here. So there's structure here, structure here, structure there. The structure just keep on being formed. Another structure here. It comes down again, structure goes above, so on and so forth. I'm sure we get the picture. I'm sure we get the picture. So look at, having said that now, the structure areas here include here. So you can see here though, let's do this. So you can see here and here are both structure lows. And what do we call that? Double bottom. Double bottom. So there are going to be times when the market is forming structure, even though ideally as traders, we would want the price or the move to break previous structure high or structure low. But there are times when it would not do that. There are times when it would go and give us a double bottom or a double top, triple bottom, triple top. It does that. So that's basically what happened here. The market swung high here. It formed a mini swing low, went back up, formed the high, came here, formed the low, formed the high, came back to this same area, equaling the previous low, hence a double bottom. Then it went like so on and so forth. So we see here, structure is being formed everywhere, all the time. Sometimes it might not be too obvious. At other times, it will be very clear. We just have to train our eyes, guys. We have to train our eyes. Let's quickly do this and move on. Let's quickly do this and move on. Where is it? What was it I want? What do I want here now? Okay, let's take this off. So you can see sometimes it's going to be, it's not going to look very pretty. Don't expect it to look very pretty all the time. You just have to be able to identify it. The market does not have to look pretty. Just trade it if it's tradable. Some people love to trade these guys. Some people love to trade the range. It is a strategy as well. Yes, there are strategies that focus on range. I don't so much like that. I prefer when it's trending. So, but looking at structure, I know we've taken our time, we've spent our time here on structure. Why? Because it is important for every trader, beginner or otherwise, that you understand structure. Let me throw this in. Patterns, strategies that requires you to trade around structure are usually very profitable if you know how to do it well. So we are spending time, never mind that. So we see now, okay, it's good we came here. It's good we came here. Why? Because some of these structures are not as you might necessarily want them. They are a bit trickier. They are a bit trickier to trade as a trader. A bit trickier to trade. Why? Because they've got long wicks, man. They've got long wicks. They've got long wicks. How do you trade such? Okay. I mean, if there were no wicks, like this one, this is kind of like fine. It's got a wick, but you can say this is structure. This is structure, very clear, not very long wicks, not very long wicks. You can see them. You can see them there. Not very long wicks, but a long wick here, a long wick there, a long wick, long wick, long wick everywhere. Now, we are not going to go too deep, but I'll give us enough to go away with, guys. I'll give us enough to go away with. Let's consider this. Now, when you see the long wicks like this, it basically tells you that this is how far the price dropped. When the price was coming down, this is how far it dropped. And guess what, guys? If price got here before, it can definitely get back here. Absolutely, it can. But then, if you're going to draw your support and resistance, if, for instance, the price is here and you are thinking of selling, okay, no, let's not here. Let's leave this one. Sell price is here. Let's take this off. Where is the? Oops. What's going on? Let's take this off. Let's take this off. So let's say the price is here and you are thinking of selling. You want to obviously have at the back of your mind an area the price might get to before it reverses or rejects that area, that price point. So when you are here, the price is going down. Now, this is assuming all this have not happened. So you see the price here, you're thinking of selling, you jump in the sell, the price is going down, it goes up, it goes down. You need to have an idea of where the price might, how far it might go. And how would you know that? You will obviously look left. As traders, we tend to look left on the chart a lot, don't we? We tend to look left on the chart. So the price is here, you look left to see where you're going to have it, where you're going to have possible support. And then you see this long wick. Now, there are two things you could do. This is the daily time frame. Presumably, you are trading off you are getting in the trade on the lower time frame, say on the 15 minutes or on the 1 hour. Having done your analysis on the higher time frame, like the daily, you are now seeking to enter on a lower time frame. So you jump in there on the lower time frame. You have already marked here. Now, different traders might mark support in a different way. Some might say they might place support here. Why? Because this is how far or how low the price dropped. Okay, that could be correct. Someone else will say, I'll place it here. Why? Because even though on this day, price came this low, let's make it bigger. Even though on this day, price came this low, it did not close here. Price was coming down. This is these are daily time frame. This is the daily time frame. So these are daily candles. On this day, it got here. Next day, there. On this day, it opened and came all the way down. Guess what, guys? Because this was a bearish day, when the price began to go down, some traders would have thought, I think we're going to have another bearish day. It's going to close as a red candle. Price was going down. It got so low and low no further. It went back up and closed here. So because price closed, the fact that the price came this low but did not close here means that, in a sense, you want to mark this area, but you also want to know that when price is beginning to come back down, it might not immediately get here all of a sudden. There might be some little bump here on the road, on the path. And that's exactly what happened. We see the price came down, it came this low, closed there, it didn't break lower, it closed there. The next day, the price went up and it began to go up away from this area until it came back down here. Now, because this is an area, a key level, that's the word again, key level, because it came to a key level, it began to oscillate there, going up, down, up, down. It began to oscillate in that area before it eventually broke through. Don't be surprised, guys. I want you to begin to get used to the fact that price would tend to slow down or oscillate at key levels. Okay. So the trader that marked this area as support is not entirely wrong. The one that marked here as support is not entirely wrong either. Now, you might wonder, I'm sure it's obvious to you why I have chosen here as support. Even without looking back, I just placed this here as support, possible support. But why would you choose here as support? Good question. It is support because, one, we see that price lingered in that area. That's usually a clue. Price lingered in this area in the past. When price was dropping, it didn't just drop all the way down, but it closed here and began to linger as though there's something special there. I've got to pick it up before I carry on. Oh yeah, and you know what that is. That is the market basically wanting to trap some people. The market makers or whoever it is, call them whatever you want to. They were waiting here knowing that people are going to jump in for a sell or a buy for that matter, and they want to get all those, liquidity, as it were, from the market before making their next move. So whenever you see price consolidating in an area, oh, guess what? You also need to consolidate with it. If I could say that. Oh my goodness, time is moving on fast. But guess what, guys? Even if we don't cover everything today, I'll quickly touch on everything. But the ones I touch on, I'm touching on them heavily because every single aspect that we intend to look at, we have planned to look at, is important. But the one we also are able to cover is going to be, it's going to be very good as well for you. So why did we choose here as possible area of support? One, because there was consolidation there in the past. And two, we see, well, how do I put this now? Perhaps it meets it meets the textbook definition of what a support and resistance zone or area is. A support and resistance zone or area are areas of the chart that price did not break through easily. See, I like to keep it very simple. We're not going to begin to pull out all kinds of grammatical terminologies from the dictionary. Let's keep it simple, guys. The price, the area or zone where price found difficult to break through easily is an area of support and resistance. So if you check here now, when the price was coming down, this was how low it went. Well, it closed there. The next day, it came, broke that area. You know what, let's do this. Let's make this bigger. Let's focus on this big candle. So let's see the low. Let's check the low of that day. That was the low, not the close. The low and the close are different. That's for another day maybe, or you could check that out. So the next day the price opened, it could not close below here. It broke below it, but it could not close below that low. The next day, the same thing. The next day, the same thing. The next day, even though there was a big move down, it did not close below this low. So that tells you that this area is support. Now I put a thin line, I put just one single line there. The best way to do it, we're not going to go that deep. The best way to do it is not to have support and resistance as thin lines. Well, you can have thin lines there or thin horizontal lines there, just to give you a visual, a visual of where you are targeting, of where you want to watch. But it's best to have it as a zone, which covers some pips. Like most of you who have seen me, trade before, or who have traded with me, you will know that I tend to have, what color it is. It's not usually maroon. It's usually blue. You will see this on my chart all the time. You're basically giving the market room to move. You are giving some allowance, as it were, to have as an area of support and resistance. Because if you consider this big candle, that was how low it got. But if you see the next high, or the next area where the candle closed, was like here, or where it opened. So I've drawn my zone to cover the very low and somewhere on the body of the candle. So we see here, so we see here now, where is it? Okay, so we see here now, having drawn this on the daily time frame, in the future, when we are trading this, after all these many days have passed, when the price comes here, expect to take profit there. I suppose that is what I was rambling on, one of the things I was meaning to say. So if you sold, having drawn up having marked up your chart, and you've drawn this as support, you entered a sell here, you want to know where you're going to possibly take profit. Key levels are areas where you plan to take profit. There are also areas where you plan to enter as well. So there are areas of entries and exits. So you sold here or anywhere here, it can go this far, but it might not necessarily go below it, on that particular day or for that trade of yours. So you will look to get out of the market. Let's mark this, let's extend it. So you entered the trade here, maybe. Let's say you enter the trade here or anywhere. Before it gets to this area which you marked. That's why you ought to mark your charts. I mean, for some of you guys, if you swing trade or you're looking for short-term trades, the weekend is when to have marked up your charts. I don't always mark up my charts. Why? Because these days I tend to do more of day trades and medium-term trades. And besides, the strategy I'm using does not so much require that I mark up my charts over the weekend or something. I basically just look at it and I can tell, how many pips I can get from the market, as it were. But if you're going to mark up your charts, because it's important, at some point, especially when you're just starting out, you mark up the charts. You are marked this up initially on a higher time frame. On this occasion, the daily, it could be 4 hour. And when the price begins to approach it, you want to come out earlier. You don't want to wait for the price to get here, because what happens sometimes is that the price could come and touch support or resistance and shoot up immediately. If you're not watching, you basically would lose all the pips or give back a lot of your pips back to the market. So if you entered anywhere at the top, you sold, you want to be coming out, maybe somewhere, some pips before it hits here. I know this is the daily time frame, so you're going to be using a lower time frame anyway to determine that. Yeah, I mean, that's about 50, almost 60 pips away. So on the lower time frame, you'll be able to be more precise. So you want to come out before it gets to the area of support and resistance. You know what I'm going to do? I'm going to quickly pause this. You know, I don't want to wait to the very end for question and answers. I'm going to pause this. Just let me pause this, and you know, let's throw it up. Let's throw it open for some Q&A. Just 1 minute, guys. Just 1 minute. Just 1 minute. Okay, so there's a question here which says, what will you advise when it comes to picking a watch list to trade? Awesome. Now, when it comes to picking a watch list to trade, there are a number of things, you know, you could consider. You know, one of them, obviously it depends. It would vary from person to person. You know, definitely. You know, obviously your trading style. You want to choose a watch list, you know, that matches or suits your trading style or your lifestyle. For instance, if you are, you know, like a lot of our members, you know, a lot of our members, you know, do have a day job. A lot of our members do have a day job, and because of that, they are not able to join me, you know, in the live trading sessions, or they're not able to trade, you know, do the live trading sessions. They're not able to trade even on their own. Why? Because they have a day job. So, you know, in that case, you would obviously prefer, you know, it would be advisable that you be a swing trader as opposed to a day trader. A day trader would be one, obviously, like I said earlier on, who opens trades in one day and closes the trade the same day. I mean, surely you cannot be a scalper unless you want to quickly take your, you know, do some trading during your lunch hour. But even then, it's not advisable because, you know, you might not have enough time to really analyze the chart. What you're going to end up doing is jumping into trades that you have no business being in, because it's almost as though you are thinking, I work Monday to Friday, you know, have my lunch, 1 hour lunch break, I will trade. You know, you are going to put yourself in a situation whereby you're going to be forcing trades. You're going to be saying, it's almost as though it is the case that you are saying, I must find a trade within this 1 hour. You don't want to do that to yourself. You know, so it's best you are a swing trader if you don't have time to trade. You know, which basically means you're going to, you know, be going into trades that you're going to have open for some days. You know, you're going to have trades open for some days. Come back from work, do your analysis, get into trades, and leave it for some days. You know, hopefully it goes in your way and you take profit. You know, whereas, you know, if you are a scalper, on the other hand, you can trade almost any pair. Almost, not every pair, almost any pair. Why? Because you want to trade pairs that will give you the number of pips you want for the day. I mean, when I'm scalping, for instance, I'm usually looking for 10 pips. You know, sometimes, you know, 15 pips, depending on the currency pair. You know, that's just the way it is. So you're looking for 10. I mean, yes. Oh, yeah. There are some scalpers that actually scalp for 2 or 3 pips. I don't want to be that kind of scalper. 10 pips is fine. 2 or 3 pips is risky. You know, so, but obviously, you know, if that's what they've mastered, then that's good for them. But if you're going to be a scalper, you want to look for pairs that will give you the number of pips that you require. For me, if it's 10 to 15 pips I'm looking for, I know what pair to go look for. It's not going to be pairs that are not volatile or pairs that are slow moving. It's not going to be pairs that have a small ADR, which is average daily range. It has to be a pair that has a large enough daily range, which basically means in a day, it moves by a lot of pips. You know, like if we consider the pound pairs, for instance, the pound pairs would usually give you at least 70 pips a day. Every day they will move at least on average 70 pips. So I'll be looking to scalp on those pairs. Now, with some brokers, if you're a scalper, so there are a number of variables to consider. With some pairs, there are some, with some brokers rather, you know, their spread is not good enough. It's not, you want to avoid currency pairs that have don't have a tight spread, like this Euro New Zealand dollar, for instance. Let's do this. Okay, well, I mean, we can see the spread here is 74 minus that, which is basically 12 pips. Now, obviously, that is wrong. That is not, when the market is closed, you will see the spread is showing something massive. But even then, you know, the spread, the spread on some pairs, on some brokers, it's 4 pips. I mean, if you are scalping, you are looking for 10 pips. You don't really want a pair that has a 4 pip spread. You are looking for something that has a 1 or 2 pip spread at the most, because before you go into profit, you will have to have cleared your spread. Anyway, good question. So there are a number of things. I mean, Femi, you know, I mean, we could consider that. You know, remind me tomorrow, you know, during the live session, I would consider that, you know, I would look at that some more with you. Otherwise, I'll find time to post it in the channel. Okay, so there's another quick question. I mean, we've got 15 minutes, guys. Don't worry. Let's quickly cover 1 or 2 more things. Do you consider multiple time frame analysis when trading high and, is that high and, what's H and S there?
Head and shoulders.
Oh my goodness. That is a technical guy. Okay, so do you consider multiple time frame analysis when trading head and shoulder on the 4-hour time frame? Do I consider? If yes, can you please explain? Now, do I consider multiple time frame analysis? To be honest with you, I don't tend to do that, you know, but if you do, it's fine as well. If you do, it's fine as well, because at least, you know, because, you know, I'm sure you've watched the video series on the website covering head and shoulder. It is the case that when you draw your head and shoulder pattern, for instance, you know, you know where you're targeting as the take profit, and you know where the stop loss is, you know. So if I mark up my head and shoulder, if I draw up my head and shoulder on 1 time frame, for instance, you know what, in saying that, I think it's best we just do it. Let's just show it. Don't worry, guys. I know we are all wanting to go watch the England match, so we'll quickly just do this head and shoulder. So at least we've covered 2 major things. Let's do this. Okay. Let's switch over to the trading view. Where is it? Now stay to the end, guys. I've got a little something for you. Where is this? Okay, share the screen. Okay. So look at this. You know, let's quickly draw the head and shoulder pattern. Let's see if we can find the head and shoulder pattern here. Okay, I mean, it's not always going to be perfect. The pattern is not always going to be perfect, but there are lots of head and shoulder pattern here. You know, as I can tell you guys, just a tip, whenever you see the chart zigzagging, we did the zigzag just now. Whenever you see the chart zigzagging, know that there is a head and shoulder somewhere. You just have to be able to identify it. When I say zigzagging, I mean the price is going up, a zig, a zag, zigzag, zigzag. That's basically what it is. You know, that's one of my theme songs. Right. Okay, so I can see some head and shoulder pattern here. I can see one here. Oh well. So now I know there are some of you who might not have had me explain this before, but you know, just try and follow quickly. So with the head and shoulder, you will see, think of this. Think of a man standing in front of you. You know, he's standing in front of you, but he's backing you. So you can only see his back, you cannot see his face. That's his head. That's his neck. That's his left shoulder. That's his right shoulder. So this is basically what the head and shoulder is. This is what it looks like, but let's basically explain. So that's his head, the back of his head, the left shoulder, the right shoulder. Okay, so that is what it is. You now have to find it on your chart. You know, there are lots of patterns you can find on your charts. You know, like I said, when I first started trading those days, I used to trade Bollinger Bands, and Bollinger Bands used to form all kinds of body parts. I'm not even going to name some of them. But anyway, so we see here, this is the head, this is the left shoulder, this is the right shoulder. So the way obviously we would trade it, you know, we will place when the price first swings in this way, this is the head and shoulder. We also have the inverse head and shoulder. When the price first swings in this way, let's make it a thick line. When the price came up from here and went up there, it formed structure. We talked of structure a while ago, forming structure because it reversed. You now mark structure there. That is a possible left shoulder. The price goes above, forming the head. When it now comes back down below that line and it begins to go back up, it's going to be meeting or forming the right shoulder. So this was the left shoulder. You drew a line there. So this is now the shoulder level. The left shoulder formed, the price went down. The head formed, the price went down. It went and formed the right shoulder. So the right shoulder obviously is where you will look to enter the trade, and you would have captured these pips. The market gave you a second opportunity because it went back to the shoulder level. Yes, it broke above it, but it came back down. Okay, so let's just quickly now draw it up proper. Let's draw it up. Oops. Okay. So okay, so there we go. There. Let's go with this one. Okay. So we see here, this is the head and shoulder, the left shoulder, the head, the right shoulder. Now the question is, will I consider multiple time frames? I would not usually do that. But if you do that, there's nothing wrong, because it basically means you are expecting the price, if it breaks a certain level, you want to know how far it will go. And a higher time frame would usually tell you how far it will go. Now, this is the 4-hour time frame. If I draw the head and shoulder here and I check the 1 hour, guess what? I would have known. Now, this is what we call the neckline. Left shoulder, head, right shoulder. This is the neckline, somewhere around here. Now, when price breaks the neckline, because it is structure, my goodness, when price breaks the neckline, you know it's probably going to go even lower. So doing multi-time frame analysis, in this case, checking a higher time frame will let you know your next take profit point. So good question, Femi. That definitely, but like I say, I don't usually trade, do multi-time frame analysis, because I want to just, trade what I see and come out. It's a pity we've not had time to look at how we will enter this today. But what I have, shared with you tonight, I believe has been eye-opening, or there would have been some light bulb moments even tonight. Now, so what we're going to do now quickly is the little something. let me do this. Let's come back here. So, you know, I know Ogechi, sorry about that. I know Ogechi came a bit late, so that's fine. I'm sure you still captured everything. Now, I am recording this, and I did say, you know, well, I did say I was going to record it. So what I'm going to do, I'm going to share the Zoom link to everyone that has turned up tonight. No one else, everyone that has turned up. I want you to send me an email. Send me an email, not post it on Telegram. Send me an email, you know, and let it be that you have as a subject special Forex session. You know, special Forex session. You know, because I want it. I want to. I will send the link to you via the email. So please send me an email, and I'll send the YouTube link for this video to that email. Now, what we cover today, Ogechi, basically includes the key level structure and all that, head and shoulder, which we have not looked at in detail, but we've answered some questions on that, which I believe are helpful and very good questions. We've not quite looked at exits and entries. You know, who knows? Who knows? I might have another session with you guys. You know, you never can tell. Now, question and answer, yes, we've had some questions. Now, the little something is, the little something basically is, you know, an offer which I basically, you know, thought to put out to, you know, some of you, especially those who are, you know, previous members. Now, these days, I'm sure you've seen in the Telegram chat and all that, that I am now heavily, I'm also now heavily focusing on copy trading, trading for, well, not trading for people, but copy trading, copying my trades to their account. You know, whereby if I take any trades, I move the stop loss or anything else, it copies automatically to their own account. I mean, there was a screenshot I posted in the copy trade service on Friday, I think it was, whereby one of those copying my trades, you know, was able to grow his account, you know, by about 10% in 2 weeks. He funded the account. He's a pastor. He's very busy. He doesn't have time to trade. I just take trades and he copies to his. So I was able to grow his account by almost 10% in 2 weeks. Now that is good. That is huge. Think of it this way. If your account is £5,000, you know, 10% of that is 500 in 2 weeks. No bank will pay you that if you were to leave that in your account. But that is not basically what I'm talking about. That is just to, you know, just by the way. I now focus a lot on copy trade service. Yes, there's still the training and the trading going on live and all that. For those who have been previous members, you know, I want you to talk to me if you are wanting. I know some of you are so busy. You know, there's one of us who is a doctor who basically joined us, who signed up to the copy trade service, you know, over the weekend, you know, because she's busy. You know, she thought she'll be able to, you know, trade with us. Like a lot of the members started off with us, but because of their busy schedule, even though they thought they could work around it, they soon realize that they can't because they're just too busy. So they've signed up to the copy trade service. So, you know, for those who are interested in the copy trade service, do, you know, let me know, and I'll give you half price, you know, to join us for the first month, half price for the copy trade service. But if you are looking, as it were, you know, to sign up again to the VIP or to the elite, then obviously what I plan to do is to let you have it instead of £55, to have it for £35 till the end of the year. So basically for the next 5 or 6 months, you could be part of the VIP at a price of £35 as opposed to £55. If you're looking to join the copy trade service, you could obviously join us, you know, at half price, you know, for the first month. And all you need to do is basically just, you know, reach out to me either by email or by email or on Telegram, and basically, you know, we'll take it from there. But with regards to getting the YouTube video link for tonight's session, send me an email. I don't know if you want to quickly write it down. If you want to quickly write it down, it's basically F for Francis, F for Basogie, which is my surname, at ymail.com. The copy trade service tends to be, well, currently is £35 per month. By God's grace, well, let's leave that anyway. It's currently about £35 per month. No, it's Ymail. Ymail for Yahoo. Yahoo also has a Ymail. So it's fobasogie at ymail.com. Send me an email and I'll forward the link to you. Anyway, let's leave it, guys. And I am rooting for England. I'm sure most of you are. So see you and speak to you soon. God bless you. Bye now.